The future of money is more dangerous than you think. For most of human history, money was something you could touch. You could feel its weight in your hand, hear it clink against a table, hide it under a mattress, or bury it in the ground if you truly needed to disappear. Money was private by default, local by nature, and limited by physical reality. But somewhere along the way, quietly, efficiently, and without much resistance, that relationship began to change. Convenience replaced control. Speed replaced privacy. And now, without most people fully realizing it, money is transforming into something fundamentally different from what it has ever been before. What makes this shift dangerous isn't just technology itself, but how subtly it rewires power. The systems that move money today no longer merely facilitate trade, they observe, record, analyze, and increasingly decide. Every purchase tells a story. Every transaction becomes data. And every data point feeds systems designed not only to understand behavior, but to shape it. This isn't science fiction. It's already happening, layer by layer, policy by policy, update by update. The future of money won't arrive with a dramatic collapse or a single announcement. It will arrive as an upgrade, a feature, a solution to fraud, a tool for safety, a promise of inclusion and efficiency. And by the time people realize what has been traded away, the old version of money, the one that allowed silence, anonymity, and refusal, will no longer exist. Money is becoming invisible. Money used to interrupt you. You had to stop, count, hand something over, and receive something back. That pause mattered. It created awareness. Today, money dissolves into the background of daily life. A tap, a swipe, a face scan, a subscription that renews itself while you sleep. Spending no longer feels like spending, it feels like permission being quietly granted. When money becomes invisible, it also becomes easier to lose control of, not just financially, but psychologically. As transactions disappear from physical reality, they migrate fully into digital systems that most people never see and never question. Payment processors, banks, fintech platforms, and algorithms become the real intermediaries of value. You don't give money to a person anymore. You send a signal to a system that decides whether the transaction is allowed, logged, flagged, delayed, or denied. The act feels instant and effortless, but behind it sits an expanding infrastructure of rules, risk scores, compliance checks, and behavioral profiling. This invisibility changes how people perceive value. When money becomes numbers on a screen, detached from effort and time, spending accelerates. Debt becomes abstract. Inflation feels confusing rather than alarming. People argue about prices while trusting systems they don't understand to manage their livelihoods. And the more invisible money becomes, the more dependent people grow on interfaces and platforms that can be changed overnight, without consent, and often without explanation. There's also a quiet transfer of authority happening. Physical cash doesn't require permission to exist or move. Digital money does. Every invisible transaction depends on uptime, approval, and compliance with terms written by institutions whose incentives don't always align with the individual. When money lived in your pocket, it worked even when the power went out. When it lives in the cloud, access is conditional, and conditions can change. The most unsettling part isn't that money is invisible, but that people are encouraged to see this as progress without trade-offs. Convenience becomes the selling point, while resilience, privacy, and autonomy are framed as outdated or even suspicious. The less people interact with money as a tangible thing, the easier it becomes to reshape what money is and what it can be used to control. Total financial surveillance. Every digital transaction leaves a trail, and those trails are no longer just stored, they're analyzed. Who you pay, when you pay, where you are, what you buy, how often you buy it, and how your behavior compares to millions of others. Financial data has become one of the most intimate and revealing forms of personal information, mapping habits, beliefs, relationships, and vulnerabilities with unsettling precision. Unlike social media posts, you can't simply stop spending money to avoid being tracked. What began as fraud prevention and regulatory compliance has evolved into a permanent architecture of financial observation. Governments demand visibility to enforce taxes and sanctions. Banks monitor behavior to manage risk and liability. Corporations harvest spending data to predict and influence future choices. None of these systems exist in isolation anymore. Data flows between them, merges, and feeds machine learning models that assign scores, flags, and probabilities to human behavior. This creates a world where financial normality is defined by algorithms. Deviate too much from expected patterns, spend differently, save unusually, transact with the wrong people or places, and attention follows. Most of the time, this surveillance is invisible, but its presence shapes behavior all the same. People self-censor not just what they say, but how they live economically, because the consequences of being flagged are often unclear and difficult to challenge. Unlike traditional surveillance, financial monitoring doesn't need cameras or microphones. It watches through necessity. You must interact with money to survive, which makes opting out nearly impossible. And as cash usage declines, so does the last meaningful form of unmonitored economic activity. What remains is a system where participation requires transparency, but power operates behind layers of opacity. The danger isn't just misuse, it's normalization. A society accustomed to total financial surveillance begins to see privacy as an inconvenience rather than a right. Control becomes justified by safety, efficiency, or morality. And once financial behavior is fully visible, it becomes fully governable, not only through laws, but through automated enforcement that operates faster than appeals, explanations, or human judgment ever could. Programmable money. Programmable money represents the final shift, from money as a neutral tool to money as an active system of rules. Unlike traditional currency, programmable money can carry conditions within it: where it can be spent, when it expires, who is allowed to receive it, what behaviors unlock or restrict access. On the surface, this sounds efficient and even helpful. Governments can deliver targeted aid, companies can reduce fraud, systems can enforce compliance automatically. But beneath that efficiency lies a profound change in the nature of ownership. When money becomes programmable, you no longer fully own it, you license it. Value is no longer unconditional, it's permission-based. The same infrastructure that ensures benefits are spent correctly can also ensure they are spent only in approved ways. The same logic that prevents fraud can prevent dissent. And once these capabilities exist, the question is no longer whether they can be used, but under what circumstances they will be used. Programmable money shifts enforcement from institutions to code. There's no need for courts, conversations, or context when rules execute automatically. A policy change becomes a software update. A behavioral violation becomes a frozen account. And because the system operates at scale, individual exceptions become expensive, slow, or politically inconvenient. The result is a form of control that feels impersonal, technical, and therefore difficult to argue against. What makes this especially powerful is how easily it integrates with surveillance systems. If money knows who you are, what you do, and how you behave, it can respond dynamically. Rewards for compliance. Restrictions for risk. Expiration dates for spending deemed unnecessary. The economy itself becomes a feedback loop, nudging behavior not through force, but through access. The most dangerous aspect of programmable money is that it doesn't need to be imposed all at once. It can be introduced gradually through optional systems, pilot programs, and incentives. People adopt it because it's easier, faster, or required for certain benefits. And over time, the non-programmable alternative quietly disappears. By the time resistance forms, the system is already embedded, not just in finance, but in daily life. Centralized power over your wallet. As money becomes fully digital, power over it concentrates naturally into fewer hands. Not because of conspiracy, but because digital systems demand coordination, standardization, and oversight. Servers must be maintained. Networks must be secured. Rules must be enforced. And whoever controls those systems, whether governments, central banks, or tightly regulated financial institutions, ultimately controls the flow of money itself. Your wallet may sit in your pocket, but the authority over what it can do increasingly sits elsewhere. Centralization changes the balance between the individual and the system. In a cash-based world, control was distributed. Millions of people held value independently, outside of any single point of failure. In a centralized digital system, money lives on ledgers that can be altered, restricted, or shut down with a few keystrokes. Access becomes a privilege rather than a given. And while these powers are usually justified as safeguards, they also introduce a level of fragility and dependence that didn't exist before. What's often overlooked is how quickly centralized control becomes normalized. Temporary measures become permanent. Emergency powers quietly expand. Policies introduced during crises rarely disappear afterward. Each layer of control adds precedent, making the next layer easier to justify. Over time, people stop asking who has the authority to intervene in their financial lives and start assuming that intervention is simply part of how the system works. This centralization also reshapes accountability. When something goes wrong, an account freeze, a denied transaction, a system error, the responsibility is diffuse. Automated systems make decisions, customer support reads scripts, and appeals disappear into digital queues. The individual faces a machine that cannot be reasoned with, only navigated. And in that environment, financial autonomy erodes not through force, but through exhaustion. The danger isn't just abuse of power, it's dependency on it. When centralized systems become the only way to participate in the economy, opting out ceases to be a realistic option. The wallet no longer belongs fully to the person who carries it, it belongs to the system that authorizes it to function. Digital currency behavioral control. Digital currency doesn't merely move money faster, it creates the infrastructure to shape human behavior at scale. When every transaction is tracked, categorized, and analyzed, spending becomes a measurable expression of compliance. Incentives can be embedded directly into the monetary system, rewarding certain actions while quietly discouraging others. Behavior no longer needs to be policed through laws alone. It can be guided economically, automatically, and continuously. This form of control is subtle because it rarely feels like punishment. Instead, it arrives as friction. A delay here, a restriction there, a benefit that requires certain conditions to be met. Over time, people adapt their behavior not because they were forced to, but because the system made alternatives inconvenient or inaccessible. Control works best when it feels voluntary, when resistance feels irrational or costly. Digital currency allows rules to follow people everywhere. Unlike traditional regulation, which is limited by geography and enforcement capacity, digital monetary rules travel with the individual. Wherever you go, whatever you buy, the system is present, watching, evaluating, responding. Financial behavior becomes a proxy for trust, loyalty, or risk. And once behavior is scored, it can be managed. The most concerning aspect is how easily moral judgments can be encoded into financial systems. What is considered essential, responsible, or acceptable spending is rarely neutral. These definitions reflect political, cultural, and economic priorities that can change over time. When money enforces those priorities automatically, dissent doesn't need to be silenced, it simply becomes unaffordable. History shows that power over resources is power over people. Digital currency refines that power into something quieter and more precise. Instead of confrontation, it offers calibration. Instead of prohibition, it offers incentives. And in doing so, it transforms money from a medium of exchange into a medium of influence. The illusion of convenience. Convenience is the most persuasive argument in favor of digital money, and also the most deceptive. Faster payments, seamless transactions, no cash to carry, no change to count. Each improvement feels small and reasonable on its own. But convenience always has a cost, and that cost is rarely paid up front. It's paid later, in the form of reduced control, reduced resilience, and reduced choice. What convenience really does is remove friction, the same friction that once gave people time to think, notice, and resist. Automatic payments bypass awareness. One click, purchases bypass deliberation. Always-on access bypass boundaries. The system is designed to feel effortless, but effortlessness often masks dependency. When things stop working, when systems go down, accounts are locked, or policies change, people realize how little agency they actually have. Convenience also narrows imagination. When a system works well enough, alternatives fade from memory. Cash becomes inconvenient. Privacy becomes suspicious. Manual control becomes inefficient. The range of acceptable options shrinks, not through prohibition, but through social and economic pressure. People stop defending what they no longer use. There's also a psychological trade being made. Convenience trains people to prioritize immediate comfort over long-term autonomy. The promise is always now, faster, easier, smoother. The consequences are always later, abstract, and easy to dismiss. By the time the trade-offs become visible, reversing them feels impractical or even dangerous. The illusion is that convenience serves the user first. In reality, it serves the system that provides it. A population optimized for convenience is easier to manage, easier to predict, and easier to control. And when money becomes convenient above all else, it stops being a tool people use and starts becoming a system they live inside. Inflation as a silent weapon. Inflation is often explained as a technical phenomenon, a byproduct of complex economic forces that feel distant and abstract to everyday life. But in practice, inflation is one of the most effective and least resisted tools of power ever created. It doesn't announce itself as a policy. It doesn't require enforcement. It doesn't provoke immediate outrage. Instead, it works quietly, persistently, and asymmetrically, reshaping society while most people struggle to name what's happening to them. As prices rise, purchasing power erodes unevenly. Those closest to the source of newly created money, banks, large institutions, asset holders, adjust first. Wages, savings, and fixed incomes adjust last, if they adjust at all. The result is a transfer of wealth that feels accidental but follows a predictable pattern. People work just as hard, sometimes harder, yet find themselves falling behind. The system doesn't need to confiscate wealth when it can dilute it. Inflation also distorts time. Saving becomes irrational. Planning becomes difficult. Long-term thinking is punished, while short-term consumption is rewarded. When money loses value simply by being held, people are pushed toward risk, speculation, or constant spending just to stand still. This creates a population that is financially anxious, reactive, and easier to steer through promises of relief or protection. Because inflation lacks a clear villain, it diffuses responsibility. Governments blame markets. Markets blame supply chains. Institutions point to global forces beyond anyone's control. Meanwhile, the impact shows up in grocery bills, rent, and energy costs, places where people have the least flexibility. The pressure is constant but rarely explosive, which makes it ideal for long-term control without open confrontation. In a fully digital monetary system, inflation becomes even more precise. It can be targeted, adjusted, and managed in ways that are invisible to most participants. Money can lose value not just over time, but conditionally. And when inflation becomes a permanent feature rather than a temporary crisis, it stops feeling like a problem to be solved and starts feeling like a fact of life, one that quietly reshapes power without ever raising its voice. Debt is the new currency. In the modern financial system, money is no longer created primarily through work or production, it is created through debt. Loans, credit lines, mortgages, and financial instruments generate the majority of money in circulation. This shifts the foundation of the economy from ownership to obligation. People don't earn their place in the system, they borrow it and spend years paying to remain there. Debt changes the psychology of money. It pulls the future into the present and locks it into contracts that shape life choices for decades. Where you live, what job you take, when you can leave, what risks you're willing to accept, all of it becomes constrained by financial commitments that cannot easily be escaped. A population in debt is not just economically active, it is economically dependent. Unlike physical money, debt is enforceable by systems designed to outlast individuals. It doesn't disappear when circumstances change. It survives job loss, illness, and even failure. And in a digital financial environment, debt enforcement becomes automated, persistent, and unforgiving. Missed payments trigger algorithms, scores drop, access narrows. The system remembers everything. Debt also functions as a filtering mechanism. Those with assets leverage debt to grow wealth. Those without assets use debt to survive. The same tools produce opposite outcomes depending on where you start. Over time, debt deepens inequality while presenting itself as opportunity. Access to credit is framed as inclusion, even when it locks people into cycles that are nearly impossible to exit. When debt becomes the dominant form of money, freedom becomes conditional. Choices require approval. Stability requires compliance. And the threat is not force, but default. In that environment, financial obedience becomes rational behavior. Not because people agree with the system, but because the cost of resisting it is simply too high. Financial exclusion at scale. In a digital-first monetary system, exclusion doesn't require physical barriers. It happens through denied access, frozen accounts, failed verifications, and silent rejections. Participation in the economy becomes contingent on meeting criteria that are often opaque, constantly changing, and impossible to negotiate with. If the system decides you don't belong, there may be no clear path back in. Financial exclusion used to be limited by logistics. Now it can scale instantly. A single policy update can affect millions. An algorithmic decision can remove access to banking, payments, or savings without human review. And because so much of modern life depends on financial infrastructure, housing, transportation, communication, exclusion becomes total, not partial. What makes this especially dangerous is how easily exclusion can be justified. Risk management, compliance, security, reputation. These are technical terms that mask human consequences. Once exclusion is framed as a neutral process rather than a moral decision, responsibility dissolves. People aren't punished, they're simply unable to access services. Digital systems also struggle with nuance. They categorize, score, and simplify. If you fall outside expected patterns because of your work, beliefs, location, or associations, you become statistically inconvenient. And statistical inconvenience, at scale, becomes grounds for exclusion. There is no malice required, only optimization. As cash disappears, so does the last fallback option. There is no parallel economy to retreat into, no anonymous medium of exchange to rely on. Financial exclusion becomes social exclusion. And when survival depends on digital access, power doesn't need to convince or persuade, it only needs to deny. Decentralization, threat or escape. Decentralization is often framed as a technical alternative, a niche preference for programmers or idealists. But in reality, it represents something far more unsettling to centralized systems, the removal of permission. A decentralized monetary structure does not ask who you are, what you believe, or whether your behavior aligns with policy. It functions without a single point of control, which makes it inefficient by design and threatening by nature. Systems built on oversight and authority cannot easily tolerate systems that operate without either. To centralized institutions, decentralization appears chaotic, risky, and difficult to regulate. And in some ways, it is. It lacks the safety rails of centralized governance. It demands personal responsibility. Mistakes are permanent. There are no help desks, no resets, no appeals. But that discomfort is also the source of its power. Decentralization shifts accountability back to the individual, reversing decades of financial paternalism that trained people to outsource control in exchange for convenience. The real tension lies in choice. Decentralized systems offer an exit, but only for those willing to understand them and accept their trade-offs. As centralized money becomes more restrictive, decentralized alternatives are increasingly portrayed as dangerous, speculative, or illegitimate. Not necessarily because they are ineffective, but because they represent competition at the level of control, not profit. What makes decentralization dangerous to the status quo is not that it replaces existing systems overnight, but that it proves another model is possible. One where value can exist without constant observation. One where participation doesn't require approval. And in a future defined by programmable, surveilled money, the mere existence of an escape route becomes a form of resistance, the gap between the aware and the asleep. As financial systems grow more complex and abstract, a quiet divide forms, not between rich and poor, but between those who understand the direction of change and those who don't. Most people experience money only at the surface level: balances, prices, payments. They feel the pressure, but not the structure causing it. Meanwhile, a smaller group watches the architecture evolve and recognizes the long-term implications before they become unavoidable. This gap isn't about intelligence, it's about attention. Modern life is engineered to exhaust it. Between work, media, and constant distraction, few people have the bandwidth to question systems that appear to function well enough. By the time consequences are visible, narratives are already set, and alternatives feel radical or unrealistic. Awareness arrives late, often after choices have narrowed. Those who are aware face a different burden. Understanding the system doesn't grant immunity from it. It creates urgency without authority, foresight without control. Conversations become difficult, warnings sound exaggerated, and preparation can feel isolating when the surrounding culture remains asleep, trusting that stability will persist simply because it always has. Over time, this gap compounds. The aware adapt early, quietly adjusting their behavior, tools, and assumptions. The asleep adapt later, under pressure, when adaptation is no longer optional. And the system doesn't slow down to accommodate late understanding. It moves forward, indifferent to who noticed in time. The real question: the future of money isn't ultimately about technology, policy, or efficiency. It's about agency, about who decides what money is allowed to do and who it is allowed to serve. Every financial innovation answers that question in one direction or another, sometimes openly, often quietly, embedded deep within the system by design. Progress is rarely neutral, and money is never just a tool. The real question is not whether digital money will dominate. It will. The real question is whether individuals will retain meaningful control within that system, or whether money will evolve into an instrument that shapes behavior more than it serves human needs. Convenience and security will always be promised. Efficiency will always be praised. The cost, however, will rarely be listed in clear terms, and by the time this question becomes impossible to ignore, the answer may already be written into the code, enforced by systems no one voted for and few truly understand. If this made you think, subscribe, like, share, and keep the conversation alive, because awareness is the last form of control we still have.